Hi guys, welcome back. Today we're going to have working capital management. What is working capital management? Working capital management is the management of the daily activities of the business. What are the items that move on a day-to-day basis? So let's think about these daily activities of the business. It's reasonable to think that businesses buy and sell regularly, pay and collect regularly. So if you're going to notice, at the point of buying, inventory goes up, accounts payable goes up. At the point of selling, inventory goes down, but AR, receivables, accounts receivables go up. At the point of the payment, the payables go down as well as cash. At the point of collection, your AR disappears and it becomes cash. So if you're going to notice, it is the current items that fluctuate on a day-to-day basis. We have cash, accounts receivable, inventory, and accounts payable. Again, these are the current items. So what does it mean when we talk about working capital? It can mean any of the two. It can mean gross working capital, which pertains to current assets, net working capital, which pertains to the difference between current assets and current liabilities. So if you're going to look at a hypothetical balance sheet, working capital management deals with the current assets and current liabilities, both sides of the accounting equation, but only on the current portions. Why? These are the things that fluctuate on a day-to-day basis. To have a better appreciation on the day-to-day activities of the business, we should be aware of two things: the operating cycle and the cash conversion cycle. The operating cycle is the period between the purchase of inventory to its eventual realization, that is, collection of cash. In other words, it is from the point of buying to the point of sale, and from the point of sale to the point of collection. This is basically one cycle of the business. We also have the cash conversion cycle. This is the period between payment for the inventory purchase and the eventual collection of cash. The cash conversion cycle begins with payment and ends with collection. So basically, this has something to do with our cash requirement. We would know how much cash we would need as an investment in working capital by knowing the cash conversion cycle. Let us proceed to the following case. The media company has an inventory conversion period of 50 days, a receivables conversion period of 25 days, and a payment cycle of 20 days. Please take note of these days given. Let's begin with the operating cycle. Again, the operating cycle is from the point of buying inventory to the eventual realization. Eventual realization meaning it is converted back into cash. So we're going to start with purchase of inventory to the sale of inventory. Then from the sale of inventory to the collection of receivables. Take note that the days in inventory or inventory conversion period is 50 days. The days receivable or the receivable conversion period is 25 days. Thus, the entire operating cycle is 75 days. Next, let's talk about the cash conversion cycle. We would be interested here of the number of days from cash outflow to cash inflow. Cash conversion cycle will not start at the purchase date, but rather we are going to start from the date of payment. Then from the date of payment until the collection of receivable. Again, cash conversion cycle is from cash outflow to cash inflow. So rather than starting at the date of purchase, we're going to start 20 days later because the days payable or the payment cycle is 20 days. Thus, we're going to have 75 days of operating cycle less the 20 days payable. We have a cash conversion cycle of 55 days. So those are the operating cycle and cash conversion cycle. This would be very useful if we want to know how much we need to invest in our working capital. Of course, the longer these days are, the more funds should be allocated to working capital. Meanwhile, if these periods are short, we would need less funds for working capital. Let us now proceed to the working capital policies. How much current assets do we need to maintain? How much current liabilities? The working capital policy ideally should be a moderate working capital policy. Here, we have to match the maturity of financing with that of the assets it finances. We also call this the hedging approach or the maturity matching approach. Again, whatever the maturity of the assets, that should be the maturity of the source of funding. Why? Well, it actually makes sense. Imagine if you will cater a special order, which would require an inventory only for 20 days. Are you going to have a 20-year loan for this inventory level? Of course not. You're going to just use a loan that would be good for 20 days. Meanwhile, if you are going to purchase a new building for the business, are you going to take a 1-month loan? Of course not. You're going to use the building for 20 or so years and better have a 20-year or so loan. So this is the logic in the maturity matching or hedging approach. We are simply matching the maturities of financing with that of the assets. Alternatively, we would rather have a conservative working capital policy. We are putting liquidity first by having to incur more costs. In a conservative working capital policy, we have to maintain more current assets and less current liabilities. What's the danger in that? Having more current assets is actually good. It will keep you safe. Anytime someone will have to bill you, you have current assets to liquidate. That's liquid. However, if we're going to maintain too much current assets for the sake of liquidity, we're also incurring opportunity costs. We have to maintain a level of current assets that require funding, and that funding can be used somewhere else where it would be profitable. But you would not do because it is trapped in your current assets. Now, if we are conservative, we will keep current liabilities low. If current liabilities are low, it is safe. However, current liabilities are cheaper than the long-term counterparts. That is why we're going to end up with more long-term financing, which is more expensive. Again, being conservative, we are going to minimize risk, being liquid. However, we have to incur more costs. Or, we may want an aggressive working capital policy. Here, we put profitability first by taking more risk. If we are using an aggressive working capital policy, the current asset level is low. Why? To have lower opportunity costs. We can free up funds to be used for some profitable venture. However, this will be less liquid. We're also going to maintain more current liabilities because this is cheaper than the long-term counterparts. Again, in using the aggressive policy, we're going to maintain low current assets and high current liabilities, thus increasing risk. However, this is less costly. To give you a visual representation of what we're talking about, refer to the following diagram. If we're going to graph the level of assets in a typical year for a seasonal business, we would find something like this. We have the level of fixed assets, permanent current assets, and seasonal current assets. Note that fixed assets will not vary on a day-to-day basis. In a typical year, assuming there's no expansion or dissolution of business, the level of fixed assets will remain same all throughout. But for current assets, there is a minimum level where we should not go below for us to maintain the business. But there's also a portion that is going to fluctuate depending on the season. If it is the season of the business, then we're going to require more inventory, more AR, more cash. But if it is the slack season, we're going back to the minimum levels. Hence, when we talk about current assets, there is a permanent level and a seasonal level. Now, if we're going to be moderate, we are going to match the maturity of financing with that of the assets. Thus, ideally, we are going to use short-term funding for our seasonal current assets and long-term funding for our permanent current assets and fixed assets. So if we have temporary levels of inventory, we should use short-term bank loans. But if we're going to maintain a permanent level of inventory, property, plant, and equipment, we are going to require a 20-year loan or a 50-year bonds perhaps. Now, if we are going to be conservative, that is, we value liquidity, we're going to keep our short-term funding at a minimum. In this case, you would see short-term funds only finance half of the seasonal current assets, with the other half, together with permanent current assets and fixed assets, to be funded by long-term sources. Again, in being conservative, we value liquidity and we have to incur more costs. Remember, long-term sources of funds are more expensive. If we are going to be aggressive, we would want higher levels of short-term funds. In this diagram, we can see that short-term funds finance all seasonal current assets and half of the permanent current assets, with long-term funds financing only half the permanent current assets and the entire fixed asset level. So these are the working capital policies that a manager may implement. Depending on the risk appetite of the manager, we can have a moderate, conservative, or an aggressive working capital policy. As an introduction to the next videos, we are going to divide working capital management into two. First, we have the management of current assets, cash, AR, inventory. We're going to talk about what's the appropriate level of each current asset and how are we going to manage them. Second, we have the financing decisions for working capital. Should we get our financing from spontaneous sources like accounts payable? Or should we look for external sources of credit like bank loans? That would be our discussion in the next videos. Comment below for other topics in management accounting and financial management. Like, share, and subscribe.